Hey guys, welcome back to the Bitcoin Fortress podcast. It is Sunday, March 29th, 2026, and this is episode 209. We are at block height 942826, Moscow time 1511, and fees are a very civilized 1, 1, and 1. This week, Bitcoin kept doing something very important. It kept acting like Bitcoin in a world that looks increasingly unstable, over-leveraged, and politically confused. We had more ETF turbulence, more macro stress, more talk about inflation, and even rate hikes, more evidence that miners are adapting in real time, and more policy drama around Bitcoin tax treatment and crypto legislation in Washington. At the same time, some of the biggest Bitcoin podcasts were circling around the exact same themes: credit stress, tax policy, legal pressure, and the growing gap between short term fear and long term infrastructure progress. So, with that, let's jump into the news from the past week, starting with market structure, ETF flows, and price action. One of the clearest themes this week was compression. Early in the week, analysts noted Bitcoin was trading in a narrow corridor while macro pressure throttled liquidity, even as spot Bitcoin ETFs had still taken in roughly $1.5 billion over a recent stretch. That matters because it tells you Bitcoin was not collapsing on its own. It was trying to stabilize while the broader macro backdrop remained hostile. When Bitcoin refuses to break down immediately in a nasty macro tape, that is worth noticing. The easy mistake is to only look at price and say nothing is happening, but sometimes the most important thing is that forced sellers seem to be running out of ammunition. That is how markets often begin transitioning from panic to base building. A separate report this week said Bitcoin's consolidation between roughly 60,000 and 75,000 reflects waning sell-side pressure from ETFs and long-term holders. In other words, the aggressive dumping may be losing steam. This is a good reminder that bottoms are usually boring before they're obvious. If you do not ring a bell at the exact low, what you often see instead is exhaustion. Bad news keeps coming, but the asset stops reacting with the same intensity. That's not a guarantee of a rally, but is exactly the kind of behavior long-term Bitcoiners should watch. Then ETF outflows and dollar strength hit again. By midweek, Bitcoin dipped back below 67,000 as ETF outflows resumed and a stronger dollar pressured liquidity. That was a useful reality check after the earlier stabilization narrative. This is why I keep saying Bitcoin does not trade in a vacuum. In the short term, it is still heavily influenced by liquidity conditions, ETF flow psychology, and global macro stress. Long term, Bitcoin wins on fundamentals. Short term, it still has to survive the mood swings of modern capital markets. Spot ETF flows clearly deteriorated as the week wore on. Farside's daily flow data showed a strong start on March 23rd with net inflows of about 167.2 million, followed by a 74.5 million net outflow on March 24th, a tiny $7.8 million inflow on March 25th, and then more meaningful outflows on March 26th. That sequence tells the story of the week in one line: initial optimism, then hesitation, then risk-off behavior. ETF demand is still massively important because it has become one of the major pipes connecting Bitcoin to traditional capital. So when those pipes reverse, you feel it quickly. By late week, the ETFs logged their biggest single-day outflow in 3 weeks. CoinDesk reported that investors pulled about $171 million from Bitcoin ETFs on March 27th, the biggest one-day outflow in 3 weeks. I would frame this as a sentiment wobble, not a thesis break. The ETF complex is still one of the strongest structural tailwinds Bitcoin has ever had, but it also makes Bitcoin more legible to traditional portfolio managers, and those people are not diamond-handed cypherpunks. They rotate, de-risk, hedge, and sell into uncertainty. Markets are now pricing more inflation risk and even possible rate hikes. By the weekend, reporting showed markets had flipped from expecting multiple Fed cuts to pricing in the possibility of rate hikes, driven by energy-led inflation fears and geopolitical stress. This is huge for Bitcoin. If markets move from disinflation and cuts to sticky inflation and tighter policy, all risk assets get repriced, but it also strengthens the long-term Bitcoin argument. The same system that keeps trying to paper over debt and energy problems is now discovering that inflation is not dead. Bitcoin was built for a world like this. Reuters reported Citi lowered its 12-month Bitcoin forecast to 112,000 from 143,000, citing stalled U.S. crypto legislation and a narrowing window for regulatory catalysts this year. Citi's bear case was 58,000 and bull case 165,000. Now, I don't care much about bank price targets, but I do care about what the downgrade implies. Wall Street increasingly sees policy clarity as a major unlock. That is both good and bad. Good because Bitcoin is no longer fringe, bad because too many people are still waiting for permission. Bitcoin does not need Washington to work, but Washington can certainly affect the timing and scale of institutional flows. All right, moving along to Bitcoin as macro signal, safe haven, and hard asset. The block reported JP Morgan observed that Bitcoin saw inflows and stronger activity during the Iran war, while gold ETFs saw outflows and silver flows unwound as well. CoinDesk similarly reported Bitcoin held its ground, while gold and silver slid on ETF outflows and liquidity strain. This is one of the most interesting developments of the week. For years, critics said Bitcoin would never behave like a safe haven asset because it was too volatile. But safe haven does not mean never moves. It means capital increasingly sees it as outside the liabilities of the existing system. If Bitcoin can hold up during war stress while metals wobble, that is a very important signal. On TFTC, Marty highlighted two major themes: global yields ripping higher amid geopolitical tension, and private credit funds gating redemptions, with the contagion path to bank balance sheets becoming more visible. This is the kind of backdrop where Bitcoin starts to make more sense to more people. If bonds are no longer truly risk-free, if private credit is less liquid than advertised, and if depositors or fund investors begin to question the plumbing, Bitcoin benefits conceptually even before it benefits price-wise. That is the slow migration from speculative asset to parallel monetary asset. Next, let's jump into corporate treasury and institutional adoption. Strategy disclosed it purchased 1,031 Bitcoin for $76.6 million between March 16th and March 22nd, bringing total holdings to a whopping 762,099 Bitcoin as of March 22nd. The number is smaller than some of their recent monster buys, but the signal is unchanged. Saylor is still buying, even in a choppy, nervous market. The largest corporate Bitcoin holder keeps converting capital into Bitcoin exposure. That matters more than the weekly size. CoinDesk reported Strategy topped up capital raising plans, restoring potential Bitcoin buying power to $42 billion, split between common stock and preferred structures. This is worth emphasizing on the show. Strategy is not just buying Bitcoin, it is industrializing the process of buying Bitcoin through capital markets. Love it or hate it, this is a major part of the institutionalization of Bitcoin. Saylor is effectively building a Bitcoin acquisition machine. CoinDesk reported Marathon, or Mara, ticker symbol, sold 15,133 Bitcoin between March 4th and March 25th for about $1.1 billion to fund a major debt restructuring and note repurchase. This is a really interesting contrast with strategy. Strategy leans harder into Bitcoin accumulation. Mara is monetizing Bitcoin to repair the balance sheet and reposition. That is not necessarily bearish. It is a reminder that miners and treasury companies are not all the same. Some use Bitcoin as a reserve asset, others use it as strategic collateral, operating inventory, or restructuring fuel. CoinDesk reported H100 is pursuing acquisitions that could bring holdings to around 3,500 Bitcoin, potentially making it Europe's largest listed Bitcoin treasury company. This is the global spread of the Saylor playbook. Even if many of these treasury firms never become giants, the fact that so many listed companies now see Bitcoin as a strategic reserve asset is itself a major cultural shift that was unthinkable not that long ago. Barron's reported Vanguard's brokerage platform has begun offering crypto ETFs, even while Vanguard still says it has no plans to launch its own crypto ETFs or mutual funds. This is another quiet legitimacy story. Vanguard was one of the most visible holdouts. Even if they are not embracing Bitcoin philosophically, access matters. The walls keep coming down. That is what institutional adoption often looks like, not fireworks, just another gate quietly opening. Moving right along to mining, energy, and the builder story. CoinDesk reported that Bitcoin network hash rate dropped roughly 8% in a week to about 920 exahash per second, likely tied to energy market disruption connected to Middle East conflict. This is a perfect example of Bitcoin reflecting the real world. Hash rate is not magic. It is attached to energy, logistics, and economics. When war stresses energy systems, the mining network feels it. But the deeper point is that Bitcoin adjusts. Difficulty, miner behavior, and energy allocation all respond dynamically. CoinDesk also reported miners are selling more Bitcoin and pivoting toward AI and data center strategies to fund the transition, while CoinShares expects network hash rate to keep rising substantially into 2026 and 2027. Some Bitcoiners instinctively dislike this story because they want pure play miners to just mine and hold. But the reality is that is actually much more nuanced. Miners own power relationships, land, cooling expertise, and data center infrastructure. In a world hungry for AI compute, those assets become more valuable. The question is whether these firms can diversify without losing their Bitcoin identity. All right, moving right along to policy, tax, and the state. First up, Reuters reported Britain plans to cap overseas political donations and ban cryptocurrency donations as part of a broader effort to reduce foreign influence in politics. This is classic state behavior. Governments claim they are banning crypto donations because of transparency and security concerns, but the underlying instinct is familiar. They distrust rails they do not fully control. Expect more of this globally. Bitcoin is permissionless money, and politics runs on permission. In Reuters' weekly crypto roundup, one of the featured developments was China expanding its digital yuan efforts while the UK moved to ban crypto donations. That contrast is striking. On one side, open monetary networks face restrictions. On the other, state-controlled digital money keeps expanding. This is why Bitcoin remains so important. It's not just about upside, it's about preserving an alternative to the programmable, surveilled, state-approved future of money. This week, TFTC reported that the Bitcoin Policy Institute brought Coinbase, River, and Block to Capitol Hill to advocate for a federal de minimis tax exemption for small Bitcoin transactions. At nearly the same time, Coinbase published a tax policy piece arguing the U.S. needs modernized digital asset tax rules. This is one of the most important undercovered stories of actual Bitcoin use in America. If every small spend creates a capital gains event, Bitcoin will remain harder to use as money. A de minimis exemption is low-hanging fruit. It would not fix everything, but it would remove one of the dumbest barriers to Bitcoin as a medium of exchange. Reporting this week said that lawmakers released the Digital Asset Parity Act, which would create a de minimis exemption for some small stablecoin transactions while leaving Bitcoin out, prompting pushback from Bitcoin advocates and the Bitcoin Policy Institute. This gets right to the heart of the policy battle. Washington likes stablecoins because they're dollar adjacent and easier to domesticate. Bitcoin is different. It is neutral, scarce, and politically harder to absorb into the existing framework. So, if lawmakers carve out conveniences for stablecoins while excluding Bitcoin, that tells you exactly where the lobbying power is concentrated. All right, let's jump into the Bitcoin podcast universe themes of the week. Theme 1, credit stress, macro fracture, and Bitcoin as the escape hatch. So we have Rabbit Hole Recap 402, The Credit Runs Continue, aired on March 27th, and What Bitcoin Did, published The Commodity Shift, Credit Crisis, and Bitcoin with Eric Yakes on March 24th. The overlap is obvious. The old credit-heavy, debt-saturated system is showing strain, and Bitcoin keeps getting discussed as the alternative rail. Theme 2, tax policy is no longer a niche issue. On March 25th, TFTC 731 featured Andrew Gordon on broken Bitcoin tax policy, IRS audit pressure, and the urgent need for reforms like de minimis exemptions. That lines up directly with the Hill briefings and tax bill debate we saw in the news this week. Theme 3, the legal and freedom tech battle is still live. What Bitcoin Did also published 5 years in prison for building a Bitcoin wallet with Lauren Rodriguez on March 24th. That pairs well with ongoing concerns around privacy tools, wallet software, and how aggressively states treat developers who build open systems. Theme 4, builders are still building. On the more bullish and cultural side, Coin Stories ran Lana Miles inside the world's biggest Bitcoin conference, What to Expect, at Bitcoin 2026 on March 26th. While Natalie's news block highlighted Bitcoin outperforming many assets during war stress and private credit instability. And finally, Theme 5, short-term fear versus long-term conviction. That may be the single biggest meta theme of the week. Whether it was ETF outflows, private credit stress, tax policy fights, or credit market cracks, most of the serious Bitcoin shows were basically saying the same thing in different language. The short-term tape still looks messy, but the long-term case for Bitcoin keeps getting stronger. So stay humble, stack sats. This week's featured Substack post is Bitcoin versus inflation. Inflation is one of those words politicians and central bankers love to soften, redefine, and explain away. But ordinary people know exactly what it means. Your savings buy less, your paycheck stretches less far, and the future feels more expensive all the time. In this week's featured Substack post, I revisit why Bitcoin matters in an inflationary world and why opting out of endless monetary debasement is not just an investment idea, but a philosophy of self-defense. As always, if you want to go deeper, please check out my 3 books, Bitcoin Fortress, a simple guide to Bitcoin for beginners, Bitcoin Retirement and Estate Planning, if you're further along and looking for something a little more advanced, and The Bitcoin Lifestyle. If you enjoy the show, those books are a great way to support the mission and keep spreading signal over noise. Well, folks, that's it for episode 209 of the Bitcoin Fortress podcast. This week reminded us that Bitcoin does not need perfect headlines to keep proving its value. The ETF tourists may come and go. Wall Street price targets may change every few weeks. Politicians may try to steer the policy conversation toward the parts of crypto that they can control. But underneath all of that, Bitcoin keeps doing what it does, surviving pressure, attracting capital, adapting through miners and builders, and offering a real alternative in a world that looks more fragile by the day. Stay humble, stack sats, and I'll see y'all next week. Bye bye.